Building a winning portfolio. Buy low, sell high. What could be easier? Yet as elementary and logical as it may sound, buying low and selling high is much easier said than done, as many a new investor would attest. What makes the concept so difficult is that it clashes with every fiber of human impulse and emotion. When stocks are blazing through a strong bull rally and every news show reports a new market high, it's hard to resist the impulse to jump in while the market's hot. Then, when stocks begin to go south and the economic outlook dims, emotion prods us to pull the plug and sell out before things get even worse. The result for the uninitiated is that they buy when stocks are pushing new highs and sell when they sink to their lowest levels. In truth, it takes nerves of steel to buy low and sell high, to put your money on the line when the market is floundering, and to sell out when everyone else is buying in. But that's what separates the winners from the losers, the rich from the rest. Only after you understand not only the psychology of the market, but also the history of the market, does it become easier to get it right. There will be fluctuations in stock prices, with high points and low points every year. Smart investors try to use those fluctuations to maximize their returns, bolstering their holdings when stocks are down, and lightening up on their positions when euphoria has driven up prices beyond reason. Buy low, sell high. Some aggressive investment managers use momentum to time their buy and sell decisions. They load up on stocks with rapidly growing earnings, but they are quick to dump them if the earnings growth rate declines. While momentum can be an important consideration in buying a stock, falling momentum can be equally important in deciding when to sell. Great stocks come in many different sizes and styles. Don't always look for the trendiest high-tech stocks. Some of the dullest companies can make great stocks. If you want to make big money in the stock market, figure out which sectors are growing the fastest and put some money in them. It isn't difficult to recognize which area has the most potential for growth over the next few decades. It's technology. If you don't have any investments in up-and-coming technology companies, then you could be missing out on some big gains in your portfolio. As uncertain as stock investing may seem, there are still many certainties in the market. One such certainty is that no matter how robust the economy or the market may seem, the next correction is always just around the corner. This is not the warning of a perpetual pessimist. It is simply a fact of the stock market. A correction, for those unfamiliar with the term, is a euphemism for a substantial drop in stock prices. The logic of the term being that when the market gets too high, it corrects itself by falling in value. There's a fine line between a correction and a crash, but one might consider a market decline of 10% to 20% to be a correction. More than 20% you could consider a crash. Throughout the past century, there have been hundreds of market corrections. They typically occur several times a year. And whenever they do, the press and the TV talk shows always treat the occasion like the second coming of 1929. They talk in dire terms, quoting the experts on the possible consequences of this unexpected bombshell and striking fear into the hearts of novice investors. But the investment veterans know that corrections are no reason for panic. They aren't even news. They are just a natural part of the stock market process. but the media frenzy that accompanies the more severe corrections tends to spook some inexperienced investors into selling their holdings in classic buy high, sell low fashion. Experienced investors know better. They wait patiently for these corrections and coolly add to their holdings when they come, loading up while prices are at a discount. In the stock market, there's often smoke, but seldom fire. Focus on the long term when the market drops and shop around for some good buys on quality stocks. Where there's smoke, there are bargains. How do you build an all-star portfolio? You do it in part by focusing on stocks that have done well for many years. What you should be looking for, the first criteria, is consistency. Once I've identified the most consistent companies, I look at how fast that growth has come. For instance, I would favor a company that's posted earnings gains of 15 to 20% per year for the past 10 years over one that's grown 5 to 10% per year. What does a stellar track record tell you about a company? Obviously, it doesn't tell you that the company will enjoy another 50 straight years of record earnings, but it does indicate that the company is probably very well managed and that it is a strong financial position and that its products or services have found a very lucrative niche in the market. All other things being equal, there's a very high comfort level investing in a company that's grown every year for a long period of time. Finally, look for companies that pay dividends. I like to see them raise those dividends every year. Not only is the rising dividend an added bonus for shareholders, it's also a sign of stability and optimism by the company. As elementary as the stock selection system may seem, sometimes simplicity can be very effective.